Hello everyone. In this lecture video, we will going to have our continuation of our discussion under the variable costing, but in particular, we will going to discuss the income statement reconciliation. First, let's have a recap on the results in the module 3.1.2. We will going to use only the scenario A, then I'll leave it up to you to use different methods for reconciliation for scenario B and C. A recap on scenario A, sales in units is 22,000, production in units is 20,000, the profit under the absorption costing is 1 million, and the profit resulted under the variable costing is 1,040,000 pesos. The requirement here is to reconcile the scenario A using the following method. Actually, in variable costing, there are four different methods that you should be aware of. The first one is the direct reconciliation method. Second is using the production and sales. Then third is using the inventory per unit. And the last one is using the inventory but in peso amount or in currency amount. Let us have our solution for the direct reconciliation. We should be able to get the difference in the amount of fixed overhead under the two methods as shown below. If you're going to take a look at module 3.1.2, the sales, variable cost of goods sold, variable expense, and fixed expenses are both the same for absorption costing and variable costing. Let's write it here. 220,000 and last one, fixed expense 100,000. Let us try to copy the amounts in the column for the variable costing. Then let's get the fixed overhead. For the absorption costing, it's 440,000 and for the variable costing, it's 400,000 pesos. Let's write it here, 440,000 and this is 400,000. Then let's get the total for the absorption costing and variable costing. This is equal to 1 million and this is 1,040,000. Then the difference of this one is 40,000, being the profit under the variable costing is higher, then we should be able to determine what causes this difference of 40,000 pesos. Sales is the same, variable cost of goods sold is the same, variable expenses is the same, fixed overhead 40,000, and fixed expense is the same. We can now have a certainty that the difference between the variable costing and the absorption costing is due to the difference under the fixed overhead. Now let us use the production and sales method. We can now say that if the level of sales is greater than the level of production, then the level of the profit under the variable costing is much higher than the absorption costing. Our production in units here is 20,000 units. Then our sales here is 22,000. Therefore, the sales is higher than the production by 2,000 units, then let's try to multiply it by our standard fixed overhead rate of 20. Then we can now get a 40,000 change in profit. This is just a tabular form on how we should be able to compute for the fixed overhead. Let us try to solve using the method number 3, wherein we will going to use the inventory in terms of units. Let us try to go back with a given from module 3.1.2. Based on the given from module 3.1.2, the beginning inventory is 4,000 units. Then let's write it here, 4,000 units. Then let's have our T account for the inventory. If we have a beginning units of 4,000 units, then the level of production will tend to increase our inventory by 20,000. Then we have sold 22,000 units. Therefore, the ending inventory here is 2,000 units. Let's write it here, 2,000 units. Since the ending inventory is lower than the beginning inventory, we can now have an understanding that the level of sales is much higher than the level of production. Let's put it here, 2,000 units, and multiply it by standard fixed overhead rate of 20 pesos. We will going to get change in profit, which is 40,000 pesos as well. Then the last one, under method 4, we will going to use the inventory in amounts. Let's try to solve this using the beginning inventory and the ending inventory. We have computed that the beginning inventory, this is given 4,000 units. Then our ending inventory is 2,000 units. Then let's try to get the amount. For the absorption costing, we will going to multiply the 4,000 units to the unit cost. And since the unit cost here, let's go back to module 3.1.2, that will be equal to 120 variable cost of goods sold plus the fixed overhead rate of 20. But remember that under the variable costing, only the variable cost of goods sold will be considered as inventoriable cost. For the absorption costing, that will be equal to 120 plus 20, that will be equal to 140. But for the variable costing, we will going to use 120 pesos only. Let's go back to our module. So it's 140, this is 120, then this is 140 again, and this is 120 also. So we have here 4,000 multiplied by 140, that will give us 560,000. Then 2,000 multiplied by 140, that will give us 280,000 pesos. Now let's try to solve for the variable costing. 4,000 multiplied by 120, that is 480. And 2,000 multiplied by 120, that will give us 240,000 pesos. Now let's get the difference between the beginning inventory and the ending inventory. 560,000 less 480,000, that will give us a difference of 80. Then for the ending inventory, 280 less 240,000, that will give us 40,000. Therefore, our change in the profit between the variable costing and the absorption costing using the beginning and ending inventory amount, that is also equal to 40,000 pesos. Okay? Just a recap in our lecture discussion, under method 1, our change in profit is 40,000. Using the production and sales data, we will going to get 40,000 change in profit. If we're going to use the ending and beginning inventory in terms of units, we will going to get 40,000 pesos. And if you're going to use the ending and beginning inventory in terms of amounts, we will going to still get 40,000 change in profit. That's the end of our lecture video for the income statement reconciliation under the variable costing. Thank you all for watching.